Broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with us today. Good morning to our colleagues in Australia, and good afternoon to our members and guests across the ditch in New Zealand. Great to have you all with us. Well, what a day. Drama plus, isn't it? Lots happening. Okay, so how's the volume, folks? If you could, somebody just... oh, good, Mike. Thank you very much. You're right on it, mate. Terrific. You can hear me. That's good. Norbert can hear me way up in the cold country with the beautiful fir trees in Canada. So we're okay. We're good to go. Right. So lot to talk about today. Alan's with us, which is great. Alexander's with us. That's good to see you again, Alexander. Alan's just joined us here. Dave V, he's a tutorial guy. So's Alan, incidentally. So's Deborah is a new client with us. We always like to have the ladies with us. We need more of them. It's funny. We don't have a lot of lady members, but in Japan, for example, Forex is absolutely dominated by the ladies. Make very, very good traders as well. Donald's with us. Gary's with us. Good to have you with us, folks. We've got a big roll-up today. George, of course. Greg, the wealth manager from Colorado Springs, and maybe further south now. Greg's son knows what a fortnight means. It's probably a British expression that I use. It means 14 nights or 2 weeks. Very common, but not used in America much. Jim C. is with us. He's the man with the most amazing mind. Jim, how you keep it all in your head, honestly, I don't know. Joel from Vero Beach is with us. Great to have you here, my friend, of course. Chris, of course. Oh, Chris is great. Chris is Mike's wife, lovely lady, and I'm going to be talking to you on Monday. Chris, for your next start of your tutorial. Wonderful. Larry's with us. Marcel, always special to have you with us, Marcel. Marcel did tutorials years back in maybe Colorado Springs or perhaps Chicago, not sure which, but he's been a member for a very, very long time. Wonderful to have you with us, Marcel. Hope you're feeling well. Mark L, of course, he's the guy who's done a couple of tutorials. He's too busy to trade. He keeps getting offered these. He figured he was retiring and would take up trading full time. And he keeps getting offered these wonderful jobs managing various factories. So he hasn't had time to make good on that promise yet. He's still working. Mick D, the famous man's with us. Mick, about time we had another lunch, mate. I enjoyed the last one so much. It was absolutely wonderful. Good to have you here as well, of course. Michael M, the dentist up in Chicago, tutorial guys. Great to have you with us, Mike, of course. S and Miles. Nathan's with us. Ned's with us. Lots of people with us. Norbert, of course, up in Canada. Paranjit, welcome, Paranjit. Good Paramjit, I hope I'm saying that right. Welcome, my friend. Peter, of course. Peter Mack, he's the short-term trading guru. Another few Peters in there as well, of course. Randy. Randy's been with us for years and years and years. Randy, I last saw you, I'm going to say, Chicago, years and years ago, and you've been with us all this time. It's wonderful to have you with us, my friend. Great to have you with us. Robert, of course. Sammy's with us. Scott, of course. Sean, tutorial guy. Stephen, Teresa, special welcome to you. And Trevor, all the Trevors, great to have you with us. Paramjit from Vancouver. Okay, you're one who probably gets some cold weather as well, eh? I'm always amazed at you guys who live up in that cold country. I hate the cold. That's why I'm living in the Gold Coast in Queensland, and I'm not moving. We did have 13 years at the beautiful Lake Taupo, right in the centre of the North Island of New Zealand. But it's got this massive, great big lake. It's 1,000 feet deep, cold water, fresh water, because it's 30 degrees. Dave's boasting 30 degrees in Vancouver today. Lovely. About 28 here, mate. Pretty nice, because we're supposedly just starting spring, but some of the plants are flowering already. So Taupo, this beautiful lake, 1,000 foot deep, probably 180 kilometers around, but it's a collapsed volcanic cone. It's right at the bottom of the mountains in the North Island, which are called Whakapapa. That's the proper Maori pronunciation, so I'm not making a rude statement, folks. And kids always seem to get a blast out of that. But beautiful, and of course when the snow melts, it all runs down in a beautiful freshwater lake. A wonderful, wonderful place most of the year, but boy, it does get cold in winter. Too cold for me. I was still playing grade rugby. I was down to about the third or fourth by then when I was 35, and I got so many broken arms and hands and fingers and bones and ribs, and then take it on with a pretty much full-time few years sailing offshore in those long races, Sydney, Hobart, Sydney, Gold Coast, what have you. Break a few more ribs, break a few more fingers. Pretty savage stuff. So the cold and I do not agree, but I have a great admiration for you stalwarts who not only put up with it, but my wife says actually loves it. My family, of course. They're great skiers apart from me. I'm not. Anyway, let's move on, folks, because we have plenty to talk about today. Let's see what we're doing. Stormy with a hint of drama. I made that heading up in the weekend, last weekend. So you can see that as we go through that I'm starting to get on the bear side of those markets, but don't let that affect you. Priorities of trading, folks. Learn about markets. Learn a good trading system with proven results. Market selection. This is vital. Everyone's got a favorite market or a favorite type of market. The vast majority of our clients say, they're interested in trading the S&P and gold. Both of those can be very, very good markets, but there are times when they're not so attractive. And if you're tied to those particular markets or any particular market, you're making yourself a hostage to mediocrity, because you must make the effort to trade markets that are active, that are moving. Trading markets that are not moving is just where all the problems come from, pretty much. So get familiar with all the different market groups. Dave, 47 degrees centigrade in Canada in June, higher than the highest high ever recorded. Wow. And west of the US is having those overheating problems, isn't it? Anyway, you could all move to Australia or New Zealand and live happily ever after. Okay, so let's move on. Just so many things to talk about today, and varied things as well. This is a chart that I put up on the website a few days ago. And you can see where this S&P is trapped just in these little cluster of red lines, which are fourth seal angles. So those of you who follow the fourth seal, you get the commentary on support and resistance and the time cycles, but the angles are also a part of the fourth seal. And they're very, very interesting because angles, of course, have qualities of both time and price. And you can see this market is just running into some really super resistance up here. This is the index, and this is an unusual chart. This is a synodic chart. A synodic month, folks, is the average length of a calendar month. In other words, you know how with our calendar, Anthony, good to hear from you, my friend. Anthony D, hot and humid Chicago. Anthony's a broker. Good to hear from you, mate. I hope you're doing really, really well, and glad to have you with us. Excuse me. So fourth seal angles have elements of time and price in them, and they're basically supplying support and resistance, which is what all these time cycles are doing. They're merely vibrations in time. But we then look at past history to determine what we think the market is likely to do. And that then becomes a little less scientific and a bit more, how do you feel about things? So this is another way of looking at a market, and this is based on 59-day bars. Each bar is 59 days, and I think it's absolutely extraordinary. The 59 is probably the dominant time cycle. It's what gave us the 2007 high and the 2009 low, pretty much to the day, and the ticks. We had a tutorial on at Taupo, New Zealand, at the S&P crash low, and fortunately we still have some members with us who were at that tutorial, or new people who are at that tutorial who can say, yep, I remember you trading that low exactly. Doesn't always have to be that accurate, because I've been flogging the idea to you for the last few tutorials that tops take time. Big tops take lots of time, but then on the other hand, all trend changes start with the daily signal. So you need to be super alert about a possible major trend change in the equities. I think we know we're well and truly into that time zone now. In fact, we're getting to the end of that particular group of time cycles. But amazing that the 59 cycle on the synodic chart, and a synodic month is equal length of months, 29.53 mean solar days in length. That might resonate with you, because it's those of you who've done a Daniel Code tutorial will say, wow, that's awfully close to Daniel Code time, which is 29.6 something. But 59, our dominant time cycle, chart high to chart high on the S&P index, 59 of those cycles, which are not exactly correct, because you would want to make this chart 59.3 and the next decimal for perfection, whereas the software can only count the nearest whole number. So this is actually a 59-day chart, but it's still absolutely extraordinary that after all this time, you've got the high of the market vibrating off the chart high at the 2007 top. I mean, I just think that's absolutely extraordinary. It has to mean something, and possibly it means a great deal, but wait for it to all unroll as it comes. So this is a variant, and I want to put on a couple of other charts here just to show you some of the difficulties you have with time cycles. So I've tried to show you here the half of the 59 cycle, which is 29.6. And again, the software can't calculate 29.6, so it gives you 30 as the nearest round number, which is actually not what I wanted, but that's all the software can display. And you can see that for the 29.6, or the nearest 30-day chart, that same time cycle, that expiring time cycle, on this time on the chart high, you can see the chart's changed slightly at the 2007 top here. You've got a chart high now to chart high in the next period, and that's that variance of plus or minus 1 period that we're limited to when we're talking about time cycles. And this is one of the reasons that we can't conveniently anyway, accurately create the time cycles. And there are other issues as well about where the lunar cycles expire. So we simply say that this stuff is accurate to plus or minus 1 period. But even on this chart, you can see that we're in the zone. If we're plus or minus 1 period, that would mean we're active for 1 period before and 1 period after. And these bars are 30 days, so they're over a month, 22 trading days on average in a calendar month. So that will show you some of the issues we have there. And when you try to go down even further, down to 14.8, you finish up with 15 days, which is not too bad. But we're talking about enormously long periods. We're talking about 2007 to 2021. And every one of these time bars is slightly out, because it's tracking 15-day cycles, not 14-day cycles. Same thing, plus or minus 1 period. but how extraordinary that we're seeing this market still remembering what it did in the 2007 top. Okay, the Olympics, folks. I guess you've been watching them. I've watched a little bit. I watched a bit of the swimming. I haven't watched the rugby or the tennis because it's sort of kind of weird, the Olympics, isn't it? Because it's you started off as an amateur sport and then got run over by the professional push. They've changed the rules to allow professionals and amateurs really to compete. So you finish up with a situation that the USA basketball team doesn't have its very best players in it. And of course, with the tennis, some of the big names, they just don't bother about going to the Olympics. It's honour and glory, but they're paying so much money they couldn't be bothered playing what's essentially an exhibition match for them. But I want to show you this clipping. This is a lass. I know nothing about kayaking other than I had a couple of kayaks for the kids when we lived on Lake Taupo. Great fun. But this is the slalom in the women's, whatever they call them, a special name for these competition kayaks. And what they do, they create this artificial waterway, and I mean it's furious. The speed of the water coming down is just quite, I mean, it's dramatic, and they've got various little markers they've got to get around and not touch them and what have you. And this lass, she's an Australian, and she had a particularly interesting backstory because both her mother and her father are very, very famous kayak contestants. Her mother, I think, got a silver medal at the Olympics. Here it is. She lost the Olympic gold in 1996 because of a time penalty. Her father, Richard, is a commentator for Channel 7 television station, that's the Australian hosting station here. Her father, Richard, he was a 10-time world champion, but he never got on the top step at the Olympics, had a penalty. So this lass was favourite to win the K1, which is one of these disciplines, and came third, and red hot favourite. She's apparently super good at this stuff for the slalom, where they're in and out, and boy, if you ever see it, it's really dramatic. But I put this in because of the part I've underlined. Courage, confidence, control. Those were the words that Jess Fox repeatedly told herself in the nerve-wracking final moments before the cannonball run. And she got her Olympic gold medal. And that's something I want you to remember as traders: courage, confidence, and control. It seems to me that those three words sum up very, very well the emotional requirement you need. You've got to have courage, put the trades on, don't brush your stops off, have them in the right place, have enough confidence in whatever system you're trading, and if it's not working for you, get another one, better still, learn to do it properly, and control, absolutely vital for trading. Risk management is everything. Market selection is everything. Okay, very good coffee this morning, I say. So there's a whole lot of technical reasons to suspect the top in equities, and it's kind of funny if you look back over the years. As you can see, I've been trading for a very long time. I remember a lot of this stuff, and it was way back in 1996 that Alan Greenspan said the market was showing irrational exuberance. Well, if that was irrational exuberance back then, have a look what's happened since then. And he was mainly focused on the Nasdaq at the time, but what's happened in the Nasdaq since the 2009 lows is even more dramatic than what you're seeing on the S&P. It's extraordinary, isn't it? I mean, some of the things that have happened to markets. Some of you who follow markets closely will have followed some of the action around a US stock called GameStop. And it's basically a franchise, a shop, what have you, that sells games. And of course, gaming is such a big thing in most people's lives. To me, it's extraordinary. My son's a really, really keen gamer. and he's 24, and my daughter, who's a bit older, she's 26. She likes it as well, but it doesn't really do it the way my son does. But I'm amazed at the number of people who are actually into this gaming. And when you actually look at it, I've actually seen some of the programs my son has. I mean, it's extraordinary how beautifully it's done. And how well done it is, and how much it's progressed over the years. But what I wanted to just mention to you was this GameStop. It's referred to as a meme stock. That the theory was that Robin Hood, the so-called free broking house, was encouraging traders to bet their COVID relief money on shares in GameStop. Now, like most of these stories, that's not true. There were some very, very big hedge funds involved, but the idea of shorting buying rather the most shorted stocks, so thereby playing against the Wall Street convention, or at least their narrative, got some very, very good results. And I remember when that was going on, that company was trading in the 80s, and ran up into the 300, might have even made 400, and did some hedge funds some serious damage. So that was sort of much approved of and cheered by the great unwashed, who of course believe if you can do it once, they can do it again, and it'll go on forever, which of course it won't. But that stock is now in the 300s, 380s, as I say, maybe 400. What's been happening with some of these more volatile stocks is just absolutely extraordinary. And of course, that's what we're trading. When we say we're trading the S&P index, or trading the futures based on the index, what is it that we're actually trading? We're actually trading the summary of the stocks that are in that particular index, which is being executed on the New York Stock Exchange. So when we say we're on a S&P futures, the price of whether that goes up or down depends on what's happening with the underlying stocks. Same for the NASDAQ. Each of these indices has a sponsor, and who consults with the exchange, but they eventually set out what are the various stocks that they will include in that particular index. But it's all based on what's happening with the underlying stocks, and there's some really interesting things been happening with those underlying stocks just really this week as much as any. But talk about irrational exuberance. I can remember back in the day seeing a Dow chart leading up to the 2000 high that sort of looked a bit like this, with the support lines just absolutely changing, the angles becoming more and more acute. Now, one thing I'm sure of is this can't last forever. If it is irrational exuberance or not, the answer is that there's a limit even to exuberance and hope. So some of the basis of levitating markets at the moment is a real concern, and in a more general way, we've got to think about what's the mechanisms that are working here. We know about the relationship between the banks and the Fed, the US Fed, which of course is duplicated everywhere in the Western world. We know about artificially low interest rates, and we should be worried that perhaps they're not artificial. I mean, is it possible, and I guess the answer is always yes, because that's what's happening, that the money supply is so huge that higher interest rates, people don't want to borrow? I don't know if that's right, but I'm not talking about money supply in the way the economists, the great witch doctors as I call them, measure the money supply. There's so many official measurements or measurements that economists use on the money supply that they tell you almost any story. But it does seem to me that the world must be absolutely awash with money for the governments, not just the US government. It's the Democrats are giving a whole new meaning to the concept of being generous with liquidity. And, this continues a pattern. Obama virtually doubled the national debt in the 8 years he was president. Trump was no better. He was a big spender. But boy, what the Democrats are coming up with, who pays for it? When does it get paid back? You look at Tesla. It made its profit. This year it's made apparently a real profit. Last year, all of its profit, and in recent years, all of its profits come from the government subsidies that it gets. Now, taxpayer subsidies for something that's a great idea, a brilliant idea, a breakthrough concept. Well, we'll talk about that a little bit more as we move on, but when governments are using taxpayers' money to achieve social ends, if that's not socialism, it's very, very close to it, isn't it? We know what's happening in housing markets. They're absolutely going off the roof. And this is happening everywhere in the Western world, folks. This isn't just a US phenomenon. I mean, in Sydney, which is the capital of the state of New South Wales, which is our biggest state, sort of the industrial powerhouse of Australia, together with Melbourne, average prices now, are well over $1 million for a house. And I mean, there's just a whole lot of places in Sydney, I promise you, that you don't want to live anyway for any money. But not only are they just well over $1 million, absolutely amazing, but they've gone up $1,200 a day on average for the last 3 months. I mean, it's extraordinary stuff, isn't it? Of course, interest rates determine asset prices. Those of you that have done any investing in fixed assets, real estate or something like it, the difference between a 6% interest rate to borrow funds and 2% is massive. These artificially low interest rates, artificially low to me because I just probably come from another era, and I really have problems believing that it's economically plausible for banks and financial institutions to go on borrowing money at the sort of rates we've had. But that's what affects housing prices and every other asset and asset prices. And if you think about it, the money that's being spent now by governments all over the world, this is not just for the US, the same thing's happening. Australia, New Zealand, Britain, Europe, although in Europe it's not so transparent, but the same thing is happening. This monopoly money supply with fiat money is really potentially dangerous. And it's never really worried me before. And there are endless discussions about fiat money and gold. Fiat money basically means there's nothing backing it. It can just be created by the Federal Reserve, which in fact is what happened. And then you've got the US Fed. It's still pumping $120 billion a month into bonds. And what else is it buying? What other securities is it buying? And at what price? I mean, is this a real definition of a Ponzi scheme? The Treasury, Congress starts off by authorizing more money, authorizes the debt limit. Treasury issues bonds. They're bought by the approved traders of bonds, and the backdrop is the Fed's going to buy them back at the rate of $120 billion a month. Absolutely extraordinary. What price are they buying them at? Must be at a profit, surely, and guarantees an end buyer for the issuance of debt by the government. But they're all the same thing. Governments have no money of their own. Governments only get money from what they collect from taxpayers. Really interesting story. Might have been Zero Hedge today. I read that. I'll scan it at least most days, that cryptocurrencies are now getting under the target for as what the Americans term the pay-fors. In other words, tax. Pay-fors are all tax. Someone else is paying, I can promise you. The government's receiving. There's the pay-fors, they put in this new legislation, the Senate's so-called bipartisan infrastructure deal. It's going to cost $550 billion. The pay-fors from taxing cryptocurrency transactions, even if anyone pays the tax, and I can assure you that's a really big question of how much they actually get to collect. But it would raise, on the optimistic figures, these figures that the government releases are always a bit brushed in their favour, maybe heavily brushed. It would raise an additional $28 billion. That's a massive amount of money. But have a look at it against what they're talking about partially funding. $550 billion investment in a transportation and electricity infrastructure. I mean, it just beggars belief, doesn't it? It's just it's extraordinary. I mean, there must come a time, surely, that we say there's a limit to this exuberance. There's a limit to what prices we can get. And today we've seen a couple of really interesting examples that are cracks, if you like, in the traditional wall. This was Robinhood. This is a when I say relatively new, I think they've been around since 2013. They're a brokerage that came up with the idea of brokerage for stocks and shares. Came up with the idea that we won't charge the client brokerage. What we'll do is we'll take their orders and we'll sell them to the biggest hedge funds, to the biggest order executing firms, and they've done extremely well. People love trading for free. That was always going to be a big deal. And then they came up with their IPO today, which is the worst big IPO debut ever. You should read a bit more about that. It's extraordinary. It's extraordinary the money they were trying to raise. Extraordinary that the SEC ever allowed them to come up with that model. But governments are absolutely prone to BS, and if you tell them that it's going to create more liquidity in the market, it's going to mean better enhanced execution for retail clients, they'll buy just about anything, and they've certainly bought this one lock, stock, and barrel. And I'm amazed that the SEC even approved it. To me, it's nothing else but front running. But anyway, it doesn't matter what I say. I'll just give you my view for what it's worth. This was the other big news from today. Amazon crashed after missing revenues. Some of you who actually follow stocks, I don't, but some of you who follow stocks, talking about here. I've got a message here from Dave. I'll come back to you, Dave, if I may. Who follow Amazon, so it's apparently falling out of bed after hours as well. So what's changing here, I think, is sentiment. The whole stock market business has just thrived beyond any measurable belief with optimism, with buy anything. I mean, you look at the big FANG stocks that have been driving NASDAQ and thereby the other markets. I mean, there's some really weird things that people are prepared to pay the prices for them. And this, I think, is the first sign we've seen of a bit of a change in sentiment. And it's a great story. Those of you who follow stocks, you'll see what this Amazon is actually doing after hours today. So here's the other interesting news on cryptocurrencies, which I've already touched on, that the Senate has stuck in a provision imposing stricter rules on cryptocurrency investors to collect more taxes. Well, good luck with that, guys. I mean, really? Governments are not terribly efficient at collecting normal taxes like the ones on capital gains and on income. So how are they going to be so much more effective? I mean, a lot of this stuff's already been law. I don't know how many people pay attention to it, but the whole appeal of cryptocurrencies has been the secrecy of them, which is why they've lent themselves so much to illicit activities, if I can put it that way. I know the people who promote cryptocurrencies say, well, no, that never happens. Of course it does. Happens all the time. I think the probabilities of any significant recovery of this new tax. Maybe we like little piggies in the air flying there. So, Dave, you mean socialism like corporate welfare, where Wall Street gets private profits and taxpayers bail for bad bets? Absolutely, and that's the old saying, isn't it, that public debts are socialised and private debts are, it might be the other way around anyway. I know it's an old saying. Yeah, that happens all the time, and much more than you know. So let's talk about some of these weird things. Electric vehicles. This is a matter that has stroked my interest, mainly because it's a bit like the gold bugs, the people who are behind promoting this idea just go on and on and on about it. You can't get through a day without something being spruiked for electric cars. And in the same way, what's amazing is a lot of the big manufacturers, not just the Teslas, a lot of the big major car companies are now saying we're going to be all electric by this date or whatever that date is. And I keep thinking about that governments don't have any money. They can create money with the stroke of the pen. That's what fiat currency is all about. And that's the gold bugs argument. But they're referencing the old gold standard, which was banned in 1971. But it's still trotted out pretty much every day. They're really good promoters on that, the people who sell bullion. So the government only has money that they collect from taxpayers. Now, if a product is so desirable socially and economically, then it will sell at an appropriate price. But government is justifying the subsidies on electric vehicles in Europe and I guess in China as well, on the basis of social responsibility, that if you believe in global warming and if you believe that we're polluting our planet with fossil fuels, which undoubtedly we are, then I guess you can get to the next step, which says if we spend government funds, that's taxpayer money, if we spend taxpayers' money on propping up businesses that can't sell their product for the price that it costs, let alone at a profit, then that's more of that's got to be very close to socialism. I understand the logic behind it, and of course we only have one planet. We've all got to live on it. And if we take care of it a bit better, of course, that'll be a good thing. But and I guess it's all about quantum, isn't it? How much is it justified spending on these sort of things? And there's many of them. That's what governments do. They find initiatives that they think are either socially desirable or more likely popular, and it'll improve their ratings for the next election, which is all politicians ever care about, and they spend your money on it. And I guess you're probably happy with it. And if you're not, it's too bad, isn't it? So equities, we're waiting on a top. We're expecting a major top in equities with our fourth seal analysis. And that analysis is based on very long-term charts, the shortest of which is the 6-day chart, where 6 trading days equals 1 bar. If you're not already subscribed to that, you have to be subscribed to the weekly updates, but you can contact Terry at support@thedanielcode.com, and he'll be happy to invoice you and switch on your access. But markets are like super tankers. Mary, someone or other, I can't remember her second name now. She was a very famous analyst during the .com era. I think she's still around. But she raised the idea that tankers, that markets are like super tankers or battleships. They're huge and they have massive momentum and they take time to turn around. And I've been talking to you over the last few weeks about asking you to look at previous important tops, and I've got a few more of those there. So here's the conundrum that you've got to juggle. Basically, when there's a major turn in market, it takes time. Then there's an initial move, and then there's the first counter trend. So it's the failed counter trend that confirms that the market's in, but that's a very long way away. And if you're trading futures, your leverage works both ways. So you can't afford to be the last one in, and the reality is that all new trends start with a daily signal. That's just a fact. But how anxious should you be about missing the top? I know that we've got a number of people who subscribe to the Fourth Seal commentary who are very, very anxious to get short. Some of them are a little bit too anxious. Just remember that the shortest time period that the Fourth Seal is based on is a 6-day chart. So really what we need to see is some selling in major US equities that is also confirmed by what happens in European equities. And that hasn't happened yet, but it may start very soon. But have a look at this. This is the NASDAQ at the 2000 top. 1, 2, 3, 4, 5, 6, 7. These are 6-day bars. 45 days down, 2 3-month rally. It's the failure of that rally that really starts the run. This is the S&P. Same thing. Initial move followed by a rally. It's the failure of that rally that really starts the run down. And it takes time. This is the Dow at the .com top. I mean, boy, I'm glad I wasn't trading that. It looks quite horrible, doesn't it? From 2000 until, you're well into 2001, August, before you start to get a consistent move down. Then you get the rally. And that's the truth about trading. So let's have a look at some other things that are happening with the Daniel Code and Peter Clark. How much the Fourth Seal subscription cost? $125 a month, and it's updated monthly. It's updated weekly, I should say. Mary Meeker, Martin Foster, thank you very much. You're spot on, mate. Mary Meeker was the lady I was talking about. Wonderful. Thank you very much, Martin. Yes, Peter, $125 a month. And contact Terry. He'll give you a subscription and switch on your access. Be happy to do that. I wanted to just go through a couple little trading points for you that might be of help. This is the US dollar, Canadian dollar, what they call the loonie. And you can see we had a perfect TO3 and blue line sell signal. See if I can bring this up on the other computer so I can be a bit clearer about that. There's the loonie hidden. Here it is. So there was that top. The high of that bar, this is July the 19th, the high of that bar was 1.2808. The Daniel Code blue line, which had been on that chart for weeks, was 1.2808. In other words, zero variance. Now, that doesn't happen all the time, but to get target recognition, which can happen at a bar high low or on the close, we do require that target recognition within 0.1%, not 1%, 0.1%. And what's terribly interesting is that over the years, some of these markets have expanded massively. Look at gold where it's trading now compared to where it was trading 2014, 2015. You would expect that variance would now be up 2 or 3 times, but it's not. Amazingly, it hasn't changed much at all. So we require that very, very perfect target recognition. And that's what runs all of the Daniel Code price signals. Now, some of these signals have an element of time in them as well, and you won't know about that unless you've done a Daniel Code tutorial. But there was the high on July the 19th, which set up a blue line and a TO3 cell. The blue line cell is the strongest of our signals. And then a few days later, on July the 26th, it created, at the close of July the 26th, it created a buy signal to be executed the next trading day, which was the Tuesday. July 26th was a Monday. And the trade was elected. In other words, once we create a signal, we don't just say buy or sell at that number or even at Daniel Code support or resistance. What we say is, once we've made the assumption that the market's ripe for a turn, you then have to get confirmation from the market. In other words, if we've got a buy signal in our trade program, the website will post the actual number to enter at and the number for the initial stop. And if that trade gets to the number of the entry, which means a reversal in this particular signal, then we say the trade has been elected. So what happens here is the trade's elected the next day. We're now long, and then what I've drawn is I've excuse me, I've moved on here. Go back to where I was. I've highlighted with the red line at 12529 the low of the bar that created the last buy signal, and that was created at the close of July 26. So if that trade is elected, which it was, then we immediately have a potential failure point. If the market takes out the low of that setup bar, then we have a failed trade. And that's where our fail signal is. And when we get a fail signal, it means we're wrong and you should stop and reverse. Now, I've talked about this briefly before. I don't know how many people have hoisted on with that idea, but very important when we get a Daniel code TO3 or plus or blue line buy or sell signal that is elected, that immediately creates a failure point potentially at the position of the setup bar, which is the bar which creates the signal. So right there, 2 days after the buy, or the first day after the buy, actually, we had a trade that took out the low of the previous day, and that up bar was July 27. 28th took out the low of the setup bar. Now, the setup bar was the bar that created the signal, so that's July the 26th. You can see that there. If that's taken out, which it was, it means we're wrong and we've got to do a stop and reverse. Okay, this creates a massive amount of trading, and essentially it's just putting you back with the trend. If this happens on the same day, then you get an outside bar, and you know how to handle that. Outside bars on a day of a new entry require a mandatory stop and reverse if it's possible for you to do it. If it's not possible, it will affect your profitability a bit, but I know some of you don't have sophisticated enough programs to put that in. If not, that's fine. But for those of you aspiring to greatness, as all of us are really, remember the DC fail point means you're wrong and you should stop and reverse. Okay, dealt with that one. Don't forget the correlations. I haven't talked about this for a while, but over the years I talk about it. Thanks, Stephen. Yeah, I was on the wrong screen. Not quite sure how. So here's the silver chart. This chart created a TO3 buy signal for today. You could have elected that to buy that either 2 ticks above the setup bar, which is not the inside bar. The setup bar is a couple of days ago. Here we are. Get up the right chart on my other computer. The setup bar, the signal was created. You can see the big down bar is July the 27th. Then we have that little inside bar on Wednesday, yesterday. And this was the buy signal. It was a TO3 plus buy signal for silver. If you took that buy signal at the normal position, you would. Remember, Daniel Code website is set up mainly to protect newbie traders. And what I say to people who are new to trading is don't trade the highs and lows of inside bars. Trade the highs and lows of the last bar that was not itself an inside bar. And that's because trading inside bars can be a bit tricky. So if you bought the high of that, it's 2,325 into today's close. Very nice. If you've done a tutorial with me, a Daniel Code tutorial, you would have bought the high of the inside bar, which was Wednesday's bar. You'd have made approximately $3,600 into today's close. Nice trade, isn't it? Okay. Very important to remember, gold and silver and the HUI index, $HUI, That's the index for the unhedged gold miners. That's 25 gold mining stocks that are don't hedge their forward production financially. And it's an index. You can't trade it on futures. You can trade it on options. But we use it simply because it creates these correlated signals as well. So gold and silver and the Huey are so highly correlated that a Daniel Code order or signal for any one of them can be executed in any other of those markets, provided the trade is executed. So we didn't have a buy signal for the S&P for today, but what we did have is a buy signal in silver. And they're so highly correlated that if you're a gold trader, you could have bought yesterday's high in the S&P, in gold, to get that same result. So correlated signals, I've talked about them at length over the years, but not recently. Be aware of them. A lot of these markets are correlated. Gold and silver are the main ones. US dollar moves in and out of inverse correlations with gold all the time. Usual position is to be inverse. If the dollar's going up, gold's going down. Dollar's going down, gold's going up. But sometimes it breaks out of that pattern, and when it does, to my experience, it's almost always resolved in favor of gold. But this was an interesting one, wasn't it? Because gold's just been stuck on support. It's been sitting on that 1796 line, the Daniel Code support line, for 4 days. In fact, it just hasn't wanted to go down. But at the same time, silver had that really, really big down bar. I'll go back one, refresh your memory. Silver had this really big down bar when gold didn't. So kind of interesting, isn't it? So that's what made this such a big trade in gold today. It was a surprise to most people, but not you if you remembered about how correlations work in the Daniel Code. I just wanted to show you something on this screen. This is 6S. This is our 6S program where we post signals every day in coffee. Now, there's been a drought in Brazil, followed by some frost, believe it or not, that have badly affected a lot of plants in the coffee growing areas and also other crops that are grown in that area as well. So we were long coffee from way down near the bottom there. We had one trade that gave us 1900. The next trade gave us 12,000. It was 17,000 2 days ago. But the point I want to show you here is gaps and true highs and true lows. This isn't widely known. When I first became a partner with Trade Navigator years ago, many years ago, I said to them, "Where's your indicator for true highs and true lows?" They said, don't know what you're talking about. What I was talking about, it's fairly common to know now, but you should, is that markets gap. And this market gapped. And as you can see, on my chart, when a market gaps, I have a tool which is in Trade Navigator that puts a little green bar at the high or the low of that move to show where the gap is. Now, markets hate gaps. Markets always try to fill the gaps. Some will do it quickly, others won't. But interesting, all this pullback until today, and including today, we've only been using the discretionary trailing stop or the more aggressive, smaller stop loss regime for the down move, because what I thought it was doing was filling the gap, and it's done that today. So the rule is, have a look at this. If you've got the tool there for your chart, make sure you put it on to show you the true highs and true lows. This is from Trade Navigator. They have that tool. And you can see the market gap. So effectively what happened is the market closed on this bar. Next day it gapped and up it went, and it left that gap. So what's actually been happening is that the market's been trying to close that gap, and now it's closed the gap. But here's the rule. If the chart low is greater than the previous day's closing low, then the true low is the previous day's closing low. So if you were selling this bar, this is the final up bar, if you were selling it, you shouldn't be selling the low, the chart low of that bar. You should be selling the close of the previous day's low minus 2 ticks, because that's a gap, and we have to account for that gap. So actually what's happened is, since the market closed on that day and moved up with the gap, the market's moved up from the close in out-of-hours trading. This happens often on weekends, but on other days as well, when there's really, really strong momentum. And we have to account for that movement. So if the chart low is greater than the previous day's close, then the true low is the previous day's close, and you must always trade two highs and two lows. True highs, I should say, and true lows. Same the other way. If the chart high, that's the number of the high of the chart that's got the gap in it, but if the portion that's on your chart, if that's less than the previous day's low, then the true high is, let me start again. If there's a gap down and the chart high, that's the portion of the bar that's on the chart, is less than the previous day's close, then the true high is the previous day's close. That's what we call true highs and true lows, and it's really, really important that you understand that for your trading. Okay, let's have a look what else we've got. Crude oil. Not many of you are trading crude oil. Have a look at this chart. This is just recent, a few days on the Success program. I've had to take off a lot of the numbers for wins and losses I've had on these charts. I finally got the stage that Trade Navigator had a heart attack, and I just couldn't handle this particular page until I cleared off all of those numbers. That's why they're only on for a fairly recent period here. But have a look at this. A $5,000 odd trade down, $4,500 straight up, an outside bar, and then we plus another $1,250 here. So, you know, there's sort of $10,500 in 3 trades there, folks. Very nice. And I think on the outside bar where a sell was elected, my recollection is we probably, I just can't remember if we got out of break even or better. But certainly crude oil is one of those that's showing a lot of life. That's one of the markets you should be thinking about trading. To put all of this in order for you, we offer a Daniel Code tutorial where you learn to trade Forex and futures, which trade exactly the same. There's no difference between Forex and futures, except for a little technical issue about where the buffer for the entry points are. But we teach you everything there is to know about trading price, and separately we teach you all about the magic and marvels of trading time, and they're quite different. In fact, they're entirely different. Just finished doing a tutorial with Greg, who's a wealth manager over in California. He's got a few more sessions still to go. The first time he saw trading time, he's absolutely overawed with it. Absolutely wonderful. So if you're interested in a tutorial that will make you into an elite trader, email me, jneedham@thedanielcode.com. Let me know you're interested, and I'll be happy to send you some promotional material, tell you what it's all about, and happy to talk to you about the Daniel Code tutorial if you wish me to. So remember, the business of trading is not to be right. The business of trading is making money. If you haven't already had a free trial, please go ahead, click the free trial button at the Daniel Code. If you have any problems with that, go to support@thedanielcode.com, email Terry at support@thedanielcode.com. If you've had a previous free trial, the computer will remember it and might give you some difficulties going in. But if you haven't had a free trial for the last 6 months, we're happy for you to have another one. You might need to contact Terry to make that happen. This is the disclaimer, which I do recommend that you read in detail. It's really serious stuff. What's more serious is if you don't know how to trade, you'll lose money, and that's a dreadful outcome. So make sure you know how to trade, that you're confident and comfortable with your own trading before you risk real money trading. And if you're not, let me know, and we can do a Daniel Code tutorial which will turn you into an elite trader. Okay, so that's it for the moment. I have one or two messages I haven't answered. This is the main one. From Akshay, if debt is running amok, could it be that equity and currency market would see major changes in trend with regard to the 30-year T-bonds? Interesting, Akshay. Bonds are pretty much controlled by the federal government within a range. Whether they decide, you're talking about the recent trends being up, if you're saying could bonds decide to dive, going down means interest rates go up. That would be the logical response. The problem is that there is so much gearing. That's what I've been talking about. There is so much borrowed money. There is so much gearing. That's where the drama part of this is going to come in. That the minute markets have a few days down, it's drama. There are screams, yells, emotional, and get this damn market up. The whole generation. I feel like an old fuddy-duddy talking about what happened in 2000 and 1996, but we've had a whole generation since the 2007 2009 crash, which was likely the end of wave 4. And if you believe that stuff, and I only believe very little bit of it, I can promise you, that's really, this market, bonds are so heavily influenced by government policy. Can they let interest rates go up? They have to sometime, and they'd like to be doing it now, but they're too frightened. When do they get over that? I don't know. But the Daniel Code will know. So if you simply follow the daily signals in the Daniel Code, you will consistently be on the right side of the market, actually. So that's it for us today, folks. And wow, here we go with more stuff here. The Industrial Revolution and music and motor cars, climate sure does change, just like the season folds the planet, etc. Even in the Egyptian drought, when the crops failed, Psalm 14.6. Yeah, David, quite right. Absolutely. And from James C., praise him, sun and moon. Praise him, all you shining stars. How wonderful. Thank you, James. And I hope you have a great weekend, my friend. How will we know when Frank is wrong? Asked Brian. He'll post it, and you can be sure of that. But if he is wrong, it'll simply mean that the market's moving on to another cycle. In fact, the amount of vibration required, remember, from a purely technical point of view, all of these Daniel Code fourth seal signals are vibrations, and the response is a mere vibration, and the Daniel Code is mute on quantum. So once we get the signal, the degree of how far it's going to move down is a matter involving other aspects of business, the economy, supply, demand, and the government. In other words, we do not have foreknowledge. We don't know what the market's going to do, but you can be sure if you follow the Daniel Code signals, you will be on the right side of the move. I can put my hand on my heart and say since the website went public in late 2008, I've never missed an important term in equities, and I'm certainly not going to start now. So make sure you're watching the Daniel Code daily signals, as well as the longer term bias from the fourth seal. Both are equally important. Okay, so David, geez, 0.1% more chance than dying from COVID. That's right. Enjoy your weekend, folks. Thank you very much for being with us, Stephen. This is from Stephen. So and so, 59.29 be off by 1 bar. Yeah, absolutely. That's what I'm saying. But that's the long-term chart. Stephen, if you look at the fourth seal commentary, you'll see that we've reduced it much more from, that's just the basis of something I was showing you today, and how amazing it was that this 59 cycle is still locking on after all these years. But look at the fourth seal commentary. We've got it down much more than that, and the daily signal to get it down closer. Thanks for being with us, folks. Enjoy your weekend. Wonderful to have you here. Look after your health. I trust you're all well. Take care. Take care. There's this dangerous COVID thing, isn't it? We're in lockdown here. Doesn't affect me. We can travel anywhere in the state, but you've got to wear a face mask when you go out. That's about the only restriction. I think that probably ends today. Some of the other states, though, New South Wales, Victoria, they're having a really bad time with this COVID. So good luck to all of you folks. Take care. Bye-bye for now. Thank you, Martin. Bye.